Consumer credit in the US absolutely plunged in November. Credit card users opting to pay back billions just in time for Christmas. You want to underscore the challenges facing the incoming Trump administration? This is one of the clearest signals yet. If so, then why are long-term interest rates rising? Because at first, these two things don't seem to make sense. That's because revolving consumer credit very closely aligns with unemployment. It isn't so much about spending because Americans love to spend and they love to borrow to do it. Yet, even they say, no thanks, bro, when they start to get nervous about jobs and incomes. What everyone hates more than not being able to spend like mad is the prospect of missing a payment. We all know a delinquency dings your credit score and can follow you around long after it happens, so it's just not worth taking the risk. Installment loans, rather than credit cards, those are interest rate sensitive, and those did increase a small amount in November, but mainly for auto purchases among the already well-to-do. Yet even that wasn't nearly enough to offset the huge decline in revolving credit, raising further concerns about what that means and how lower rates couldn't bring in more borrowers. And the reason is simply jobs. Americans are voting on the state of the labor market with their wallets. But if credit, and especially credit card use, is another sign of deterioration in the labor market, why again are long-term interest rates rising? And the answer to that is, well, as we'll see here, globally synchronized. But first we got to start with what happened with the consumer credit report that was issued by the Federal Reserve of all places just yesterday. As I said, credit card usage, revolving credit, declined sharply, and it was only partly offset by an increase in interest rate sensitive non-revolving or installment credit. So non-revolving credit increased by $6.2 billion. This is the seasonally adjusted aggregate balance. This is not a flow necessarily, as it is the Fed's estimate of how much is outstanding across the consumer economy and consumer borrowing. So it increased by $6.2 billion seasonally adjusted in the month of November. And that includes everything from student loans to loans on appliances, but mainly automobiles. We've already seen an uptick in automobile spending from the Census Bureau and retail sales. Plus, the BEA reported a rise in auto units sold. So it makes sense that there would be an increase in installment loans related to automobile purchases. And the $6.2 billion increase in November is the most since July, and this tends to be noisy too. So you look at how the 6-month average has evolved, and it was down around $940 million, getting close to zero back in May as interest rates were still high, though market rates were already coming down by that point. But they had moved back up in the middle part of the year. But since May, as interest rates overall declined during the summertime, the 6-month average through November rose back to $5.5 billion, which is not a huge number, but especially considering how installment loans, especially being interest rate sensitive, they're not really responding to lower interest rates. Maybe consumers aren't perceiving rates going down that much, or maybe there's not enough of them thinking that a lower interest rate is worth taking on the additional debt and the additional risk to buy whatever it is, automobiles that they want to buy. But the big one though, revolving credit. Credit card usage absolutely plunged, down $13.7 billion. Again, the seasonally adjusted aggregate balance compared to October. By the end of November, down around another $14 billion, which is the biggest single month decline since August of 2020. And it's the third decline in the balance, and I pointed this out a couple months ago, the third decline over the last 6 months. And we do have to point out that consumer revolving credit rose sharply, $15.2 billion in October. So there was a bit of risk taking, or maybe it was just emergency spending and emergency borrowing in October. And then consumers took it right back in November, right when they should be doing the opposite in time for Christmas. So you look at those 2 months together, you average them out, and it's barely a positive increase, just $700 million between the two. So $700 million per month between the 2 months. It's even less than the 6-month average for the change in revolving credit, which is $1.7 billion. So overall, the plunge in November, big time slowdown in credit card usage heading into the late part of the year and the holidays, which suggests that consumers are getting more and more concerned about jobs and incomes having nothing to do with interest rates, little to do with interest rates. And again, it's not about spending, it's about perceptions of jobs and incomes. We talk about this labor connection with a whole bunch of other stuff, not just revolving credit, at our deep dive analysis at Eurodollar University. We even have a free blog over there where we post some of our past deep dive analysis so you can check out what it's like, what we're talking about, the detail that we get into. There's also a ton more available for subscribers beyond what you see in the blog or even here on YouTube. We really go deep into these topics and we cover a whole bunch of topics at our deep dive analysis. So check that out, the free blog as well as the DDA subscription, and Eurodollar University AI is part of the DDA subscription at our website, eurodollar.university. When you look at the changes in revolving credit through time, especially during cycles, the unemployment rate goes up, credit card usage goes down. That's why we're showing you on the charts here that the credit card usage is inverted. So credit card usage goes down, which is up on the chart, the same time the unemployment rate rises, and those things make perfect sense. As I said at the introduction, nobody wants to miss a payment. They may have to every once in a while, but most people, if they don't have to miss a payment, they'll do everything they can possibly do to avoid doing so. So if you think the labor market is getting increasingly dicey, there's no jobs, there's no potential to go to a better one, you're not going to get a raise or not nearly enough of a raise as you might thought you were going to. You hear your bosses talking about maybe we have to lay off workers, we have to cut back hours, a whole bunch of negative stuff. You start holding the line on credit card usage. That's why the unemployment rate corresponds so strongly with revolving credit. Plus, the other side of this is the banking sector. The banking sector, when analyzing credit card usage, as well as applications that come in, applications for new credit lines, as well as to raise existing credit lines, credit card companies themselves, as we've seen over the last 6 months or so, are increasingly saying, no, thank you. So even though there might be a demand for more credit card usage, even the banks are starting to cut back because they get all the information on the labor market, incomes, jobs, which is the biggest factor in determining whether or not they want to give credit. So credit card usage is very closely tied to what's happening in the labor market. And we've seen, as I've talked about yesterday, a whole bunch of data that came in for the same month of November that already suggested continued deterioration in employment. JOLTS, for example, hiring rate continues to crash. It's gone way down, and it stayed way down, showing that September's increase in the hiring rate was the anomaly. And June's shocking low was nearly matched in November. And when you put it in terms of a hiring rate, it was matched in November. Quits, right along exactly what we're talking about here. Americans don't use their credit cards because they're afraid of the labor market. They also stop quitting their jobs for exactly the same reason. So it corresponds near exactly there as well. And now we're seeing layoffs on the rise too in terms of JOLTS. So we put it all together with the household survey, the unemployment rate, the adjusted unemployment rate, the one I adjust based on putting back labor force dropouts. All of it combined, corroborated by credit card usage among American consumers who would love to use their credit cards, but in November at the very least, and really going back to, very importantly, March and April, they have increasingly opted not to. With all of these labor market signals, these negative labor market signals that are proliferating and as well as being corroborated by one another in all different data sources, and as I said in yesterday's video, even the energy market like gasoline. So why the hell are treasury yields at the long end rising? For a lot of people who understand what treasury yields actually mean, lower interest rates are a bad sign consistent with an economy heading toward recession, lower growth and inflation expectations, higher demand for safety. So if the economy is in a bad shape, why are interest rates at the long end going up when they should be going down? What we see in U.S. Treasury is nothing more than the yield curve is steepening out. There's a couple different things, but first of all, the yield curve is steepening out. And that just simply means that short-term rates are moving down faster than long-term rates. And long-term rates are moving down too, just not in a single straight line. Nothing ever goes in a straight line. So over the last year of this bond market rally, we've seen long-term interest rates go down faster than short-term rates in the initial part of the rally at the end of 2023. Then they moved back up in the first part of 2024. And then short-term rates really started to go down during the summertime rally where both short and long-term rates went down. But since then, they've diverged, which is not unusual. We get to this first stage where central banks start cutting rates and governments start responding to the same weakness that's embedded in the yield curve. You start to see short-term rates continue to go lower while long-term rates either go higher or at least stop going lower. The steepening process isn't where everything goes down at the same time in the same way with just short-term rates going down a little bit more. Instead, the steepening process often includes this divergence. Short-term rates go lower, reflecting a bunch of stuff, including what central banks are likely to do, while longer-term rates go a little bit higher and reacting to the impending response by officials. Because everybody knows once the economy gets to a certain point where it's weak enough and everybody can see it and they can no longer ignore and lie about it, governments are going to respond to it. So we're in that initial phase. And it's not just the United States, as I said. We see the same thing around the rest of the world. German long-term rates are higher, despite the fact that Europe's economy is in much clearer trouble than the US economy is. Both are in trouble, but it's much clearer over there in Europe. And yet, German long-term rates are rising anyway. And we even have to consider the differences in the central banks here, because the ECB is on a much clearer path toward lower interest rates, where the Fed has no idea where it is, and we saw that in the minutes that came out yesterday. Essentially, the Fed is completely confused and lost, where the ECB is not lost. They're ignoring consumer prices as they should, and instead focusing on the labor market, which continues to show more and more signs of weakness. And yet, European and especially German long-term rates are rising anyway. Not as much as in treasuries, but they're going up because that's the part of the yield curve steepening that we're in. We see the same thing in Canada. Canadian interest rates, even though the Bank of Canada has been far more aggressive in cutting rates in response to far clearer weakness in the Canadian economy than compared to the Fed and the US economy, long-term interest rates in Canada are rising a little bit too, like Germany, not nearly as much as treasuries. So the fact that long-term rates are rising, even though there's much clearer deterioration in Canada or Europe especially, tells you that this is part of the process. We also saw this in 2019, which may be a very good example, a very good analog to what's happening here. We'll start with Canada. Canadian rates fell during what we call the landmine here at Eurodollar University, which is a whole bunch of chaotic financial conditions, collateral shortages, dollar squeeze at the end of 2018, heading into 2019. That's when really everything started to fall apart. The Canadian curve inverted in July of 2019, and while the Bank of Canada never did actually cut rates until the pandemic, they clearly stated they were going to stop hiking rates while the Fed started cutting, and they promised not to hike rates until everything cleared up, which it actually wouldn't. So Canadian rates were falling on the promise that there would be no more rate hikes from the Bank of Canada, as well as interest rates going down around the rest of the world. But yet, despite the fact that there was a fall off in the Canadian economy, as well as growing signs of a worsening global situation, from the middle of 2019, really August 2019, all the way through the rest of the year, Canadian rates began to rise, especially at the long end. But even the 2-year rate rose as well, even as the economic situation worsened, which sounds very familiar. So we're talking about a 4.5 month, almost 5-month period where rates were going up as, at the very least, the situation seemed to progress in the wrong direction. Same thing in Europe too. The German bond rally during that cycle, which we call Eurodollar number 4, that began all the way back in February 2018, which was a warning to the rest of the world because the rest of the world did follow in that direction. Took a big leg lower after October 2018, again, the landmine in line with China, but before the treasury market rally really started up at that same time. And by October 2018, the German 10-year was yielding 55 basis points. And you fast forward to September 2019, it was down to minus 74 basis points. And why it was minus and that deeply negative, that has to do with collateral, which we're not going to get into here. And what happened in early September? Well, the Federal Reserve started cutting rates back at the end of July, as well early August, that time period. But in early September, the ECB responded with a rate cut of its own, at least the deposit rate floor, a 10 basis point cut there. Plus, they restarted QE. And they restarted QE because, as Mario Draghi said in September of 2019, we still think the probability of recession for the euro area is small, but it's gone up. Understated as always. And central bankers always have to downplay the risk. But if it's enough where they can see the weakness, that they make a statement like that, but it's not even what they say, it's what they do. Draghi admitted the recession risks had gone up, but they were acting on those risks with the restart of QE and lower interest rates. So what happens in the bond market during these periods is, first of all, they follow a big rally where the bond market, if you're a bond market speculator or participant, you've made a ton of money on bonds, safety and liquidity, lower growth and inflation expectations, because things look increasingly worse. So you have a huge rally in the bond market, which then the weakness that propels the bond rally forces central banks and governments to respond to it, because eventually it becomes too big to continue to ignore and, as I said, lie about. Central banks respond, and in that response period, the market backs off. Because bond markets, like it or not, they give officials a chance. And from a trader's perspective, you made a ton of money, you take some profits off the table. You see, maybe this stuff will work. Maybe another QE will help. Maybe lower interest rates could get the economy out of, prevent it from getting into a worse situation. So the bond market participants, like any other marketplace, you see speculators, you see a variety of opinions. Those who were very strongly negative, therefore piling into safety and liquidity before, they made some bunch of money. Central banks and governments respond. They back off. Some people believe in central bank responses. Interest rates go up because nothing goes in a straight line. And from a trader's perspective, what better way to make more money than to sit back during this period where you're not really sure what will happen, what the response to the official reaction will be, and just wait for, in this case, rates to go up so that you can buy bonds all over again at a cheaper price. So this is common. We see this not just in 2019. We saw it in 2008 a couple times. We saw it in 2001. We saw it in the 1990-91 S&L recession. Rates go down, big rally before the recession. Governments respond because they belatedly see the recession. Rates back up because people made a lot of money. They take some off the table. They take some time to assess the situation. Want to see what happens. Does the economy actually respond to what central banks are doing? And then if it doesn't, which is what all the data we got now says, they go back into it. That's why nothing ever goes in a straight line. And we experienced this already once last year. We had a rally at the end of 2023 and then a 4-month-long pause up until April in treasuries and up until the end of May in European and Canadian yields. We've got about a 4-month pause already in government bonds all across the world going back to the middle of September. It's very consistent with the same pattern. But it's the economic data that continues to be worrisome, especially anything that's related to the labor market. And that includes consumer credit. So while non-revolving credit has accelerated a bit, it hasn't really accelerated all that much despite lower interest rates and perceptions of Federal Reserve rate cuts. So that's already a warning sign. But the big one, revolving credit, which is highly correlated to the cyclical aspects of the economy, starting with jobs and incomes. As much as Americans want to borrow to spend, they won't do it if they're afraid of their jobs and incomes. So the slowdown in revolving credit looks exactly like you see heading into each recession that we've had, where we have data for revolving credit, including 1990, go back 30 years. And against all of that, bond yields are going up, which isn't inconsistent with the steepening process in the yield curve, because even places that are visibly worse off, like Europe today or Europe in 2019, markets just don't go in a straight line. But if economic fundamentals are negative on the whole, like we see globally synchronized heading into 2025, rising dollar and everything else, then bonds will eventually rally whenever they get to the point where they've exhausted their patience in the economy's response function to central bank policies. That's the thing, though. The fundamentals of the global economy continue to deteriorate. That's what all the evidence shows. And it's not even just the global economy. Rising dollar? It's just not as clear in the United States, which is why the Federal Reserve is so confused. However, Americans, especially American consumers and American credit card users, they can see it, and they are acting accordingly. What American credit card users can see is a potential beverage curve cliff, and I went over what that is in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Check out our deep dive analysis at our website, and until next time, take care.